Who's the worst politician right now? Here are our thoughts and argue with us on our podcast, The World Leader Leaderboard. Find it over on the TLDR Podcast YouTube channel or in your favourite podcast app. So let's get straight into it. Before last week, Trump's economy looked to be outperforming expectations on two fronts: inflation and growth. Let's start with inflation. Basically, every orthodox economist expected inflation to rise under Trump because of both his tariffs and the fact that his unorthodox economic policies had caused the dollar to decline, which would both make imports more expensive. However, that's not quite how things panned out. Headline inflation actually fell from 3% when Trump took office to a low of 2.3% in April, just a smidge above the Federal Reserve's 2% target. While it's risen since then, coming in at 2.4% in May and 2.7% in June, this is still better than the recent average and far less than most economists were predicting. Trump has been helped here by a steady decline in global energy prices, with oil prices falling from about $80 in January to about $65 today. As the past few years have made apparent, oil prices, and energy prices more generally, have a massive impact on headline inflation rates. Anyway, aside from inflation, the second way in which the US economy looked to be outperforming expectations was that GDP growth looked surprisingly strong. Again, most economists thought that the uncertainty induced by Trump's chaotic tariff agenda would encourage foreign investors to take their money out of the US and undermine both consumer and business confidence inside the country, leading to less consumption and investment, and thus lower GDP. However, until recently, it looked like things were going surprisingly well. While there was a slight contraction in the first quarter, most people think this was mainly because of a surge in imports as American businesses rushed to import before Trump's tariffs kicked in. Because one of the four components of GDP is net exports, i.e. exports minus imports, this steep increase in imports caused a steep but temporary drop in GDP. The US economy then bounced back remarkably well in the second quarter, growing at an annualized rate of 3%, and last month the Bureau of Labor Statistics, or BLS, claimed that the economy had added 147,000 jobs in June, far more than the 115,000 or so expected. This was widely taken as evidence that the US economy was doing better than expected. After all, in general, more jobs means a stronger economy. So you get the idea. Before last week, it looked like the US economy was outperforming expectations, with inflation coming in surprisingly low and growth surprisingly high. However, data released late last week cast doubt on both of these narratives. First, there was the so-called Core Personal Consumption Expenditure Price Index, or CPE, which was published by the Bureau of Economic Analysis on Thursday. The CPE is basically a measure of inflation that excludes volatile items like food and energy, and it's the Federal Reserve's preferred measure of underlying inflation. Unfortunately for Trump, CPE ticked up in June, rising by 0.3% month-on-month and 2.8% year-on-year, a fair bit above the Federal Reserve's 2% target. In more bad news for Trump, it doesn't look like this increase was driven by strong consumer demand. According to the same report, consumer spending only rose by 0.1% last month, and was mostly driven by increases in spending on healthcare, housing, and utilities. This is evidence that Trump's tariffs are indeed inflationary, but their inflationary impact was just delayed, both because many of the tariffs Trump has announced haven't actually come into force yet, and because businesses have been happy to accept lower profits rather than increase prices in the hope that Trump will U-turn, which looks increasingly unlikely. There was then more bad news in the LS Jobs report, which was published on Friday. Not only did the US add just 73,000 jobs in July, but the BLS also dramatically revised down the figures for the previous 2 months, with June revised down from 147,000 to just 14,000, and May revised down from 144,000 to just 19,000. It's hard to overstate how bad this is. If you exclude the pandemic, this is the weakest quarter of job growth since 2010, when the US economy was still recovering from 2008. Furthermore, the vast majority of new jobs came in healthcare, and if you exclude healthcare, job growth was actually flat in July and negative in the previous 2 months. On top of this, the overall unemployment rate is being flattered by the fact that an increasing number of working-age Americans are now designated as economically inactive, i.e. out of work, but not looking for work for some reason. These people don't show up in the official unemployment data, which only counts people who are out of work but looking for work. And if you include them, the actual unemployment rate rises to 4.9%, the highest figure since late 2016, excluding the pandemic. This weak jobs report has also encouraged people to take a second look at the second quarter GDP report we mentioned earlier. And, well, it turns out that while headline GDP growth was indeed pretty strong, coming in at an annualized rate of 3%, quite a lot of that was driven by an unprecedented spike in exports, which was always going to happen after that pre-tariff spike in imports we saw in the first quarter, and spending on AI data centers. In the second quarter alone, the so-called Big Seven spent more than $100 billion investing in data centers for AI. And, somewhat astonishingly, AI-related investment actually contributed nearly 1 percentage point to GDP growth, more than domestic consumption. This doesn't even include the so-called multiplier effect of this AI spending. The builders who are getting paid to build these data centers, for instance, then spent that money in the wider economy. And more widely, this AI boom is pushing the stock market to new highs, giving confidence and cash to anyone with money in US stocks. Now, if AI does genuinely revolutionize the economy, this might all turn out to be productive investment, and Trump might get to enjoy an AI-driven economic boom. But if it doesn't, or if that process takes longer than anticipated, this AI-related investment will slow dramatically, possibly crashing the stock market and plausibly pushing the US into recession. All in all, the US economy is suddenly looking somewhat stagflationary, and dangerously dependent on healthcare and AI. All of this plays into a broader feeling coming out of America at the moment.